Morning, everybody. Morning, sorry to interrupt. Morning. Right, so welcome everybody. My name is Colin White, I'm from Credit Connect Media. This is our spring think tank. We've been running these events since COVID, so it's nearly 5-6 years now. And we've been running this event face-to-face, obviously, since the pandemic, and it's come back. We usually run it as a November event next to our Credit and Collections Technology Awards. But now we've thought it was a good time to kind of make it into a 6-month event. So this is the spring edition. We have the other one in November in Manchester. And the idea is we think there's more to talk about on a regular basis. People are meeting and going to events and planning them in a bit more. So that's the idea of our think tank. And it's more about, these events are not about just attending and listening to the speakers. It's hopefully going away with takeaways post-event and hopefully implementing them into your business. But on that note, these events don't just happen. They need a lot of planning, a lot of support. So I'd like to thank our sponsors. You can see up there, Coeo, who sponsor our industry leaders, which you'll talk more about later at lunchtime. You'll hear about that. Ardent Credit Services, Quailco, Liberata, TCN, and Yakara for their support. Because they support our event, I appreciate if you do get a moment to come and speak to them on their stands, that would be really useful. Or if you see them around, that'd be good as well. Just to give you more information, there's a commercial credit and collections conference going on in another room in the building. That's focused on the B2B sector, which I know some of you might be interested in for future reference, but that talks around the challenges for the commercial sector. A little bit about the agenda in here today. It speaks for itself really in terms of what's going on. As I mentioned at lunchtime, we'll be having the industry leaders announcements. The idea behind that, which I'll talk more about later, is we'll also be giving out a recognition award for somebody in the industry who's made a contribution. So that will be good to announce that later on, and we'll have a news story around that as well. As I mentioned, get involved today. You can see Slido there. Please ask questions. There's a couple of polls on there as well, and surveys. That'd be great. Anything we don't cover off today, we do a little review on the website next Thursday, and we'll cover off questions that we don't cover. So don't worry if you've asked a question, we haven't had time to cover it today. It's something we will look at and respond on with our speakers. Just trying to think, is there anything else? Yeah, so there's a survey that Chris will talk more about in a minute. But yeah, as I mentioned about the people who work hard and help me with the events, so big thanks to, I'll introduce him now, Chris Warburton from RO Strategy. Chris is going to chair the event today and keep everything running smooth in here, and I'll be across the 2 events, and you'll see me at lunch. But for now, hope you have a great day, and thanks for coming, and speak to you later. Thank you.
So thanks, Colin. So great to be here. New time slot as well. So it's great to actually see everyone in person rather than being necessarily on the screen when we're doing it virtually. So we're just going to go to a little bit about me first. So my name's Chris Warburton. I've been working in the industry, in the collections and recoveries industry, probably for about 30 years now, through various different sort of iterations. What I do at the moment is spend a lot of time I work for a company called RO Strategy, and we spend a lot of time doing research and looking at technology, obviously work with Colin as well, really looking around what are some of the latest trends, technology, some of the latest ideas and thinking, and bubbling that up to the wider industry and audience. So that's a little bit about what I do. I'm going to be chairing the event. My role, as much as anything, is to make sure we get the conversation going. We've got a great series of panelists throughout today. As I say, we've got four areas we're going to cover. First one is really around, I suppose, credit and collections risks. We've seen a lot of credit risks recently, I suppose. We've got inflation that's going on in the background. We're going to talk a bit about that. We've got regulatory risk. We've got board reporting that's out from the FCA. We've got new developments from the FCA. We're going to talk about all of that within the first section. Then we've got a section coming up, I suppose, around addressing affordability and customer vulnerability. That continues to be a focus. We've got a panel that's going to be talking about that. Great set of speakers. And then, as Colin said, we're going to have a bit of a break. We had the Industry Leaders Awards at 12:30. And then in the afternoon, then we'll talk a bit about customer engagement. And much of collections, as we all know, comes down to engaging customers. So we'll talk a bit about that. And then to finish off, we'll talk about AI, which has been a hot topic recently, but really just to understand, I suppose, a little bit about the latest status of AI. Where do we sit? Where does it sit within everyone's business here? And particularly, we want to talk about, throughout all the sessions, around what does it mean for us, and what are some of the tools and techniques and some of the thinking that we're putting to play within the industry as well. So really, it's around sort of trying to make it real for everyone here. As Colin alluded to, I also have a survey. We have a survey coming out here as well, and so I wanted to put that up there. If you want to take part in the survey, just click on the link here. You're more than welcome to take a part. You don't have to put your name on it. It's anonymous. What that is really to talk about is digital collections. Where do we sit in terms of digital collections? Great to get everyone's feedback. If we get enough responses here today, we'll give you the results today in terms of what everyone thinks in this room here, in terms of like where we sit in terms of digital collections, get a bit of feedback, and that'll be bespoke just for this group here. And if we don't get to it at the end, then Colin will send it out. We'll send a bespoke report as well. So specialist report just for these guys here, but it'd be great to try and get you guys feeding back on there as well. It's only about 10 questions or so. So I'll leave that up there for a minute. The first session we're going to talk about then, I suppose, is credit collections challenges and risks and challenges. And joining me on the panel today is Eleanor Demuth. So come and join us. Sam Baker, so Eleanor's from JaJa Finance. Sam Baker, also from 118 Money. And Jason Wassell, who's from the Consumer Credit Trade Association. I suppose this session here, we're going to talk about some of the big risks that are going on in the sector at the moment, and potentially on the horizon. I mean, as we know, there's been a lot of talk of cost of living, but really I'm going to talk about inflation and stressed customers. That's one of the risks that's out there. There's prospect of yet more regulatory changes that we've talked about sort of in the pre-meeting. We've had consumer duty come through. We're up to the second iteration of the board reporting. We've got product sales data that goes live in October 25, so in October this year, so that's quite a lot of level of detail. And then we're talking about just the changes around things like FOS complaints. We'll talk a bit about that. And then also things like the motor finance ruling that came out as well. And then, of course, the other big risk that's out there is really around the economy, which I'd say is probably sputtering. We look at just the latest inflation figures, and definitely got an uncertain political background. So that's the sort of the environment that we've got kind of going on in the background that we're operating in with a certain extent. And I suppose we're going to chat about that a little bit with the panel, just really around how we're kind of dealing with that really. So to start off, so welcome everyone. Thanks very much for joining. So Eleanor, I was going to come to you first and just talk about, I've just listed some of the larger macroeconomic kind of pressures that are out there, the wider environment. I mean, for JaJa Finance, how do you sort of see the environment and the risk environment as it kind of sits today? I mean, what's your kind of view on it? And I think we need to use the microphones, I think, so if we can.
Do we need to test the microphones? No, they're working. Yeah. So I wouldn't say this was specific to us, but I think there's definitely an increasing consumer need for credit, but it's more and more stratified. So there's kind of your traditional transactors who just want a credit card to use as a credit card, maybe collect some points, do all that stuff. And then there's people for whom it's going to take at least 6 months to pay off whatever they're using. And there's not much in between. So we've got this weird M-shaped population within credit cards right now. And I think that's entirely driven by the state of the economy, the cost of living, and of course the, people like Klarna and so on who are lending the 3 months in between for specific consumer spend. But it's an interesting time. We're seeing plenty of demand, but at the same time, not a consistent usage. It's one end or the other.
So you're seeing that, I suppose, in terms of, so you've got people who are struggling at the end, that's an increasing population, and then people who are probably prime customers, and they're still fine, and they're sort of still expanding, and it's sort of becoming more sort of, bifurcated, I suppose, to a certain extent.
Exactly. It's a stratified space right now, which is interesting. And what people are spending their credit on has changed a little bit as well. People are more likely to be doing their big shop on credit. and less likely to be eating out, we're finding. But at the same time, the cost of those things has changed anyway. So the cost of your big monthly shop or whatever has become something that is worth putting on credit, as long as you pay it off at the end of the month.
And Sam, I suppose, what are you seeing within your business in terms of some of the things that maybe you're picking up in terms of like trends with your customer base?
I guess was too loud. Following on from that, I think customers' relationship with spending is changing, obviously, due to cost of living and inflationary pressures, global economic trade pressures, etc., and uncertainty. Consumer confidence is down, but customers' relationship with credit, I think, is changing too. I think in days gone by, credit cards were perceived as something that people could obtain to obtain the goods and services that they needed at any given point in time. But with the cost of living crisis, people want credit and access to credit. They want headroom on their credit cards. So the way in which people transact with credit cards is changing. The way in which people pay credit cards is changing. No longer is mortgage, the one that will be paid first and prominently and the rest go. I think people, particularly in the cost of living crisis, want access to credit, and their behaviour with the credit card associated to that is changing.
And so that's quite interesting. And Jason, what's for your members? You obviously talk with a wide group across the industry. I mean, how do your members see that? And I think the comment around it, sort of like the use of credit's kind of changing, probably since COVID, I'd imagine, in terms of like our relationship with borrowing. Seems like that's changing for probably different segments of the population, I would think.
Yeah, I'll just test, is this working? Yeah. I think my fellow panel members probably have a better idea of what's happening at the very front line. They probably know what's happening with customers better than I do, but I think I'll probably say more about some of the regulatory matters and the regulatory questions. I'll have more to say there. But I guess at a macro level, I can talk about the fact that there's a lot of information out there that tells us that people are under pressure, that just less than, just more than, it doesn't really matter. But there is a big chunk of the population that doesn't have enough in their bank account, in their savings, to deal with 3 months worth of expenditure, and that came out from the Financial Lives survey. I would push everybody to read that to get a better idea of how people are using products and how they see products, and I would certainly push people towards that. And there is independent research by organizations like Fair for All that kind of suggest that vulnerable customer base could be as high as 20 million people. And I guess once again at that macro level, and maybe bringing it back to regulatory a little bit, I can assure you that a lot of the conversations I have with the FCA are about vulnerability and about your actions, your decisions, and how you look at that through the prism of vulnerability. So whilst there's a lot of conversation about how do we lend more, how do we grow, that is not going away as a big regulatory issue. And I think that the regulators do recognise that the public's under pressure and are interested in how we can help them.
I mean, you did see that, you mentioned the Financial Lives survey, which I think came out a few days ago, wasn't it? One of the things I picked up on that was where you can see real sort of like problem debt coming in was particularly around things like utility spend. So energy, feels like that energy cost and that sort of cost of living was a real kind of like pressure that kind of came through. Vulnerability was obviously there as well. I don't know if you had a reaction to that.
Yeah, I think you're right. I think we're involved in organisations like the Money Advice Liaison Group, and we kind of go along to hear what the debt advisors are saying about their activity on the front line. And I certainly think we've seen a move towards utilities, council tax, debt, and some of the stories around that are incredible about how quickly people will move to tackle those problems. And so I think there's lots to be learned from the regulated sector, and I think there's lots of support that can be provided. And I think that's where the FCA is going now, is towards that kind of customized, tailored approach to dealing with when people do find themselves in trouble. And as I said, there's a lot around vulnerability in terms of the guidance, the link into consumer duty. There's so much there to be read into for people to pick up on and use in their thinking and decision making.
And I suppose going back to you, Sam, I suppose just in terms of we can see this change that's coming through. I mean, what kind of strategies are you finding kind of works best, within the collection sector, but also in terms of the lending sector, to sort of adapt to this kind of changing environment that we're kind of seeing?
Yeah, I think, it'd be no surprise to anyone here for me to hear me say that I think collections is more about driving engagement, and the behavioural psychologies around how to maximise engagement from your customers. So I think you need to pivot on your strategies and your psychologies around your tonalities within your communications. But I think more important than that is once you have that engagement with your customer, is to offer those tailored forbearance solutions. Certainly in my experience of where I've been in past and recent past, it's still very solid in terms of what can be offered. It's got to be in keeping with how you provision, how you're funded, etc. And I think the industry needs to pivot more towards having flexible solutions for customers, because that's the way in which the FCA is going to place the demand on the industry in any event. Yeah. But I think we as an industry need to not be dragged kicking and screaming into that. I think we need to be the thought leaders in that.
Yeah. So the personalisation links with I suppose, responding to vulnerability and financial difficulties and the regulatory piece as well.
On vulnerability, actually, I think, again, in my experience, vulnerability has been something that the industry doesn't understand and doesn't want to deal with. Typically, you will identify vulnerability reactively from customers rather than proactively, and then once it's identified, it will be pushed to one side, and customers will be managed accordingly with a small specialist team. They don't receive the same services from firms as a typical customer in collections will, and I think again that's somewhere where we need to change. Customers in vulnerability needed to be treated not as someone who is on the side, but with individual circumstances considered.
Yeah. And Eleanor, what is your kind of view in terms of different strategies that we need to put in place? I mean, Sam's just talked there a little bit about how do we customise experience or engagement to try and sort of deal with these different, I suppose, this bifurcation or the bipolarity of the book now. I mean, what do you think is the best way to kind of react to that? Because you've got a group that's doing it okay, and they'll have one types of issues, particularly if they're in collections, and you'll have another group that maybe is struggling a little bit more. I mean, does it change our strategies at all, or is it still the same?
I don't think it's necessarily even a matter of that bipolarity indicating that one group is fine and the other group is not. What we're seeing is a great deal more exceptions to both areas. Volatility in people's income, for example. I see people saying, oh, you can't possibly lend to people who don't have a full-time job. And I'm thinking, really? My partner works 3 days a week, he's doing all right. Or people saying, oh, well, folks on 0 hours contracts, obviously they can't be lent to. And I'm thinking, I used to be a consultant. You know what I mean? There's a lot of exceptions and peculiarities to people's lives that just didn't exist before. And I think, especially in collections, the standard thing is, what can you afford every month for the rest of your life? And it's actually not like that. People might have a contract coming up in 3 months' time that will pay the lot off. And in the meantime, they can't afford to pay you anything. So, and at the same time, we're also expected to be super, super fair. So if one person's in this situation and another person is in technically the same situation, which is only down to how many questions you ask, we're none of us in the same situation, then you have to treat them the same. They might as well be the same person. It doesn't work like that. It's not real, right? So I think my main hint and tip would be beware the data you seek, because once you've got it, you've got to use it. You know what I'm saying, folks.
Yeah. And I suppose it's the new technology can sort of help us with this almost like messiness of people's lives. I suppose that's why we're seeing it, which is people's lives we're just reflecting reality, which is some people don't work full time, and so some people are doing 0 hours contracts. And it's like, how do we then build systems around that to find the value in that from a lending point of view, and then understand it from a collections point of view?
Yeah. But there is still an expectation out there that we work 9 to 5 in an office probably. None of us are factory workers. Good God, bashing pieces of metal together. Who does that? In order to be creditworthy, you almost have to fit this weird assumption of normality, which doesn't exist.
Yeah.
And I think forbearance in particular has been quite polarised in that, the FCA kind of dictates you have to define and set your own thresholds as to what you consider a short versus a long-term affordability concern and treat your customer accordingly. Now, what you talk about there is you don't have a polarised section of people. You have lots of people in lots of different situations. You cannot have a draconian 6-month rule on a repayment plan, or it's appropriate to default you. I think, you need to take into account individual circumstances and understand how they impact a customer's ability to repay and over what period. So I think, that diversification in the middle, I guess, of customer affordability relative to their jobs means that you have to assess customers in different ways and forbear them in different ways.
I suppose it almost comes down to, like, from a data point of view, a risk of going down a rabbit hole. It's like we used to think of it in terms of your credit score, right? So whatever your credit score, that was it, and that was the one number we used to deal with. Now we've almost got like infinite attributes to now describe everyone and the complexity of everyone, but it allows us to do that now. Now we can sort of try and find where the opportunity is within that. Does that kind of make sense, or what do you think?
I think we've already touched upon a few things we could come back to in a little bit more detail, but we've talked about affordability, we've talked about the complexity of people's lives, the need to customize and tailor the product, but also how we deal with it if things go wrong. So there's so much we've already touched upon there that shows how complicated this all is and how sophisticated we have to be going forward, and how big the challenge is. This is not simple. It is difficult, and it's becoming more difficult.
So I mean, I just mentioned there, I suppose, around credit bureau scoring, and I suppose the extra complexity, and Jason, I was going to come to you on that, in terms of, like, do we need extra data, I suppose, to sort of describe that kind of those kind of principles, and, particularly for these financially stretched customers? I mean, what kind of alternatives have you heard that people are looking at? I mean, does it best describe a customer these days?
Yeah, I've spent a year on a group that's going to create the new credit reporting governance body, which is the first part of the remedies around solving credit information. And I've been on the committee of reciprocity, and it's taken me 2 years to learn how to say reciprocity. But because people have seen me at conferences where I've struggled over, how do you say that? But I've been on that committee for a couple of years, so now I probably understand it. And I've been doing this, so I probably know more about credit reporting than I ever should be. Naveed's here. Naveed should have been doing this, but he was too busy, and I got given it. And a year later, I'm still doing it. So I think it's really interesting to see what's been happening there. I think that we know from the past that the credit bureaus were built for certain products, and it was for that customer that is 9 to 5 in an office, wants a mortgage. We can wait for the information to catch up because this happens once every 5 years. It wasn't built for the products that my members provide. It wasn't built for the customers that my members serve. And I think we've seen that. And I think some of the figures from Financial Lives, you can tell I've read it, you can tell I've been on trains for the last couple of days, and I've gone through it, but Financial Lives shows some horrible figures in there. 3 million people declined credit, nearly 6 million people not bothering to try for credit because they think they're going to get turned down. So I think there's certainly something there about how that links to credit bureaus, because I think you can look at, I don't understand it still. I don't understand how credit scoring works still. I don't understand some of the decisions that credit reference agencies come up with. Things like, I've paid off a loan, I paid off a line of credit, I'm going to close it down. That damages my score because my credit utilization goes in the wrong direction. I apply for a loan, they suggest they're going to give me this percentage, they give me another percentage. I'm almost driven to take that because I know that the more times I go and ask for a quote from other places, the more my score will be damaged. So there are some real problems there, I think, but it's not the answer. There are bigger things here that we need to tackle. It's just one element, just one part. There are bigger things about the regulatory landscape. Credit information is interesting, it's useful in certain parts, but it's not the keys to the kingdom.
Well, I mean, so I know we were chatting the group before here, so we're talking about affordability, and so like, I mean, the regulator seems quite focused on affordability, and we talked about vulnerability, we talk about financial difficulties. I mean, you know, is that the right measure, I suppose, is kind of the provocative kind of question. We talked about whether, you know, credit bureaus, is that enough information? Affordability, is that the right information as well? I mean, because that can be difficult to gather that information, and does it lead to better outcomes? I don't know, you're kind of smiling at me, but something controversial to say.
Well, I don't want to tread on the affordability session, but I mean, there's everything to be said for assessing affordability, but assessing it correctly is like, you know, the be-all and end-all, and it's not easy. And I think what people tend to forget, I say people, we don't forget, but, you know, maybe the FCA forgets, maybe the consumer themselves forgets, is that the very application for credit indicates that something is going on. You need a new fridge, or you're about to go on holiday, or something has changed, because otherwise why are you applying for a new line of credit, right? So to take a snapshot of affordability and say, oh, well, this is okay, this is going to continue forever, at that point it's ludicrous, because the indication is that something's going to change. So, I mean, like I say, I'm not going to tread on the toes of affordability, but my considered advice is look for the first differential, not the actual figure.
So what are some of the measures that we should be looking at? Some of the data points that we should be looking at? I mean, maybe Sam, I don't know if you want to comment on that. So, I mean, affordability is kind of one aspect of it. We can look at changes, as you were just saying. But I mean, are there other data points that can be maybe more indicative around whether the loan is sustainable? I think is probably really what we're looking for, isn't it?
Yeah, I think, you know, the typical job of a scorecard, right, is to look backwards, to look forwards. And I think what we're saying here is that's not always the best approach. Now, I don't want to go slightly out of scientific and into, but I think, you know, open banking is obviously a solution to that. I think it's helping customers who have regular incomes but not good, you know, perhaps credit files, get access to credit at better price points. So I think the expansion of open banking, but I think also the customer comfort with open banking will help the industry. Beyond that, I think, you know, there's, you know, a lot of chat around, or there's been for some time, around social demographics and how much you can tell about someone and their spending patterns and their spending abilities from social media. But I, you know, obviously step into that with caution.
Yeah. Jason.
Yeah, I'm in the fortunate position I can be very, very critical of the FCA. I can bend bridges. In fact, I'm paid to do that. I'm paid to say truth to power. I'm not going to get a Section 166 next week because I say something that sparks an interest from the FCA. And I do that a lot. I try to always be, it's part of our brand. Our brand is to be edgy and to be, we're not UK Finance, we're not the FLA. We're smaller lenders, we can be edgy. And I can say to them, I have said to them, I've been in the room where I've said to them, you have become obsessed with affordability. And I can show you research that shows that that is not a great indicator of success or failure. I can show you that this is a snapshot, and that snapshot will radically change if I take that snapshot again in a few months' time for the customers that we serve. I can tell you that it doesn't work for those that have got a irregular income, irregular expenditure, like the families that I come from. I came from a council estate. People were working 2-3 jobs. They were relying on shifts. They were relying on, that kind of putting things together, which now we would like, the euphemism would be a portfolio. No, that's the way that people worked. And I can tell you that you've missed the trick, because the trick was to focus on vulnerability, because you've been so focused on trying to come up with some scientific method to work out whether people are going to pay or not pay, and you think it's affordability and it's not. But you know what? It doesn't matter. It doesn't matter, because this is an area where the FCA is not interested in outcomes, because it's just interested in trying to prove this article of faith that it's had for a number of years, because it's spent a number of years focused on this. I'm old enough, it doesn't look like it, I know, but I'm old enough to have been pre-FCA. I was here when the OFT were talking about affordability, when we looked at the Consumer Credit Directive remember directives. I was here at that point. I was there when the FCA took over. So I've seen the development of this. And they've committed so much to it that they find it very difficult to pull back. So bizarrely, it doesn't matter if affordability is good or bad. We still need to do it. And that's the strange position we're in.
Yeah. And I suppose, are we in the point, I suppose, with affordability? Because intellectually it makes sense. I suppose it's just the reality on the ground around whether that's the right thing for us to look at. So how do we sort of bridge that gap in terms of finding processes or trying to persuade the industry or the regulator around we're putting in processes that work the best for the customers rather than things that we think work best for the customers? I mean, are we in danger of that in terms of almost like an academic exercise versus an exercise in reality in terms of what actually works?
But we've tried the academic exercise. We've provided them with studies that follow customers. We've showed them what their affordability score is. We've showed what happens, and still they don't care. Because we know, everybody in this room knows, the reason things go wrong is events. People lose their job. People find a relationship breaks down. That shift goes that they were relying on. Those are the reasons. Something happens, something breaks down. That's the reason why people don't pay. That's the reason why things kind of fail. And you can't factor for that. So they will come back to you and say, that's great, Jason, can we put in some buffers now to compensate for that? And you're like, how? You can't compensate for somebody losing their job. Unfortunately, some people are going to find themselves in a difficult position because things will happen to them, and that is the inconvenient truth of credit, that sometimes it will lead to debt, and there's not a lot we can do about that.
And I suppose for Sam and Eleanor, I mean, how do we best balance that? It's almost like, we're being asked to proactively provide support for customers, as an example, based off something that might have happened in terms of what happened in the past. We have these sort of historic kind of reviews. How do we sort of, at what point does that, I suppose, go too far in terms of in terms of constraining us running our businesses, in terms of, putting in lots of processes and almost like overprotecting customers versus not? Because the wind definitely seems to be in the direction of sort of more controls, more reviews, more affordability checks, those kind of things. I mean, is it going too far, do you think? Maybe you guys don't want to answer that.
I can answer some of that. I mean, in terms of more checks, more reviews, more everything, again, I do not want to piss on the AI section, but that's your answer, and we're leaning towards 100% quality control on our stuff, because we don't think that sampling is ever going to be good enough again, right? But in terms of affordability, I wouldn't say that it's not the be-all and end-all. It could be the be-all and end-all, because historically what we've got is a credit score that predicts a combination of affordability and volatility. That's literally what they're saying. It's saying this person is stable enough that they haven't cocked up on their mortgage in the last 10 years, and they've got enough money to pay their current credit. That's basically it. That's what a credit score has been doing. But now we've got that separation of here is credit worthiness, right, and here is affordability, and in combination somehow that's supposed to work. Well, you're double counting some of it for a start, because some of it's already embedded in the credit score. But also, as I said, unless you look at the future rather than the past on affordability, there's not much point anyway. So I think, the art of predicting the future is becoming more and more important, but it can be done with beautiful things like the pattern of ATM use and whether or not people have got more than 6 financial apps on their phone. It's some weird data, and it's big data, but that's how you can truly predict the future. I mean, my personal favourite was one where someone was going, we can definitely lend to the spouses of people that are, totally well up there and paying really well and have got really high credit scores. And I'm like, really? You can lend to their spouses? They're like, yeah, the data shows that they're absolutely dependable. And I'm like, okay, if their spouse is applying for a credit product, independent of the person who is paying the bills, does that not maybe suggest that they might be breaking up soon? That's your very basic kind of future prediction. Could it be that this relationship is on the rocks? Because otherwise they'd just get a joint credit card, right? if they're applying in their own name, that in itself is an indicator. And I'm not going to give away my trade secrets, of which I have many, but thinking about the future rather than relying on throwing all the data at a wall, which is what a lot of people do. They just throw the data at a wall and go, what's predictive? What's predictive? No, think about what it means. Get into that data and go, what's the difference between a date of birth and the number of years since you first got a job? There's a difference, right? The quality is in those data transformations, which, as I said, I'm not going to tell you, but I could.
I mean, I suppose coming back to risks, there's the credit risk here, which is like using the data to decide it, but there's also the regulatory risk, right, which is if you don't do this, if you don't do affordability checks, if you don't if you don't take into account what these situations should be and be almost like overly protective around your customer base, then you can get fined, right? I mean, that's really the regulatory risk kind of there. Sam, coming to you, how do you react to that in terms of, you're talking about some of the things we can do within the data, but there's a reality around what we're being told to do as well, which might not be the same as the data.
Yeah,
in terms of getting the best outcome.
Methodology.
Yeah.
Do not tell me to use standard methodology. I've been inventing new stuff all my life.
Yeah.
Oh no, but that's not safe. No, the FCA doesn't like that because they've not seen it before. And it makes me want to hit them probably.
But how do we navigate that, right? Because to Jason's point, affordability might not be the best measure, but it's one of the things that we're kind of expected to do, right? So it's how do we navigate that between what the data says is the right thing to do and we might feel is the right thing to do versus what we're being told to do? And trying to get the best of both, I suppose, from a financial outcome. Sam, I'll get your comment.
Yeah, it's actually a discussion we've been having internally recently. The regulator will give you a framework, and sometimes that's a very narrow framework to operate within. But ultimately, it's as a firm, it's up to you to decide where you sit in terms of the risk spectrum within that framework. And wherever you sit, you justify your outcomes. So I have no problem taking risk as long as I can justify the outcomes. Now, I think perhaps that's the way, the regulator may see that you've stepped outside the boundaries of the framework in which they operate. But to your point, I think it was yours, is as far as customer outcomes go, it can't be a mathematical outcome on whether you can afford or not. I think, we talked about affordability as a binary measure of a yes or no. But affordability is different for different products. It's different for a credit card, which is you can introduce credit limit decreases. You can introduce different things for different customer affordabilities at different point, versus a fixed term securitized loan against a motor vehicle, for example. Now, customers experiencing financial difficulties over a period of time have different risk exposed to each of those products. So I think assessing affordability as a binary point at acquisition is not necessarily the solution to understanding and treating customers following acquisition. Now, again, the point to that is if you acquire the customer and you acquire them perhaps slightly differently to how the FCA expects you to, with different data to just traditional credit reporting data and scorecards, evidence the customer outcomes.
Yeah. So, but in some ways you're saying the customer outcome kind of focused and the environment we're in now gives you a little bit of defence, I suppose, if you've got good reporting and evidencing to say, look, we did the right thing, right? And I can demonstrate it was the right thing.
Yeah, Consumer Duty talks about, fair price and value and products and services, and it talks about also within Conc 7 being reasonable and proportionate. Now, as long as you're considering those things and you're evidencing that customers are receiving fair price and value, they are receiving good customer outcomes, we're operating within the framework, just not traditionally how might be asked of us by the FCA.
Yeah, yeah. Jason, you look like you want to do it.
No, I think that's right. I think that where affordability is kind of sitting now is almost like for me, it's almost like a hygiene test that the FCA will expect you to do it. But there's a lot of work that could be done elsewhere, and in particular around vulnerability. And I think you were talking about Sam. You were talking about in some structures, vulnerable customers will be moved into a vulnerability team. Certain sectors I'm in, the FCA will say, I think 100% of your customer base is vulnerable. So start with that assumption. Then they won't write it down, but they'll say it in a meeting. They'll say, I start with the assumption that the fact that they're using your product means that they are vulnerable. And that then changes the way that you have to approach this, and then you then talk about multiple vulnerabilities. And I think there's a huge amount of work. I started this by talking about that prism of vulnerability. Do not take my negativity about the FCA to say that there is not vital and important things that we need to be doing, particularly around vulnerability. We need to be identifying multiple vulnerabilities and what that will mean, what that impact on customers and how we work with that. And that starts with at home in terms of thinking about the information you have, the processes, the decisions you take, and there is that test that we all know about, your mother test, your grandmother test. Would you provide this product to your grandmother, to your mother? And if they went through the journey, would it work for them as well? There's those simple things there that we can talk about, strengthening compliance, thinking about what's out there as well. If you are not looking at affordability, if you are not looking at disclosure, then what are you doing? Absolutely, and I find, because I go across motor finance, retail, high cost, because I go through all these things, I've seen sectors that have seen things happening elsewhere and say, that's not us. And we're much better than that sector over there. Don't worry, it's never going to come to us. And I'm always like, listen to what the FCA is saying about that sector and think about what it means for your sector, because it will come to you eventually. And we've seen that with things like motor finance. Affordability started in the high-cost products, high-cost short-term, home collected, guarantor. It's now absolutely into credit cards and motor finance. And the journey is clear. And if you haven't been thinking about that by now, then I don't know what you're doing in this sector.
I mean, you mentioned motor finance now, I suppose, things coming from different areas. I mean, you've got the redress schemes going on. I don't know if you just want to comment around that. I mean, are there things that we can learn, other sectors can learn from what happened with that, with the court judgment that kind of came out? What can we learn? Because I think there's a motor finance conference earlier this week, so I'm not sure how many motor finance folks we got here, but it was like, what can we learn from other sectors as a result of that? And then we'll talk a bit about FOS complaints as well.
I guess it's back to regulatory, and sorry, I'm kind of hogging this, but this is kind of, I guess, my area. And as I said, I've been involved in high cost, I've been involved in home collected, high cost short-term home collected, guarantor, pawnbroking, that journey into kind of other credit lines and into motor finance. And my hope is nobody's going to put two and two together and work out that it's me, that I'm the common denominator. I'm just hoping that nobody does that, because that could be career shortening. But what I have seen is that it's gone from much smaller sectors into bigger sectors. If you think about what's happened with high cost, we're talking about a market of a couple of million, 2 to 5 million, and now we're into much bigger sectors when we talk about motor finance. So what I've seen is these issues, in particular under the influence of the financial ombudsman, have gone from small sectors to bigger sectors and are now of interest to us all.
Yeah. I mean, Sam and Ella, Eleanor, I suppose things like, we've got things like other things that are coming up, so things like board reporting, product sales data that's coming up. I mean, like, what are the things we've got to have on our radar that could be like coming from elsewhere or coming from the regulator that are sort of keeping you guys kind of awake at night, really? If we look at the future in terms of that regulatory risk, what are the changes that you're kind of worried about, or not worried about, as keeping an eye on?
I'm slightly concerned about the weaponisation of the FOS fees. I think we're seeing a greater, not necessarily consumer awareness, but almost faux consumer awareness. You know, everyone thinks they know how their credit score works now. And they can say things to us like, you've damaged my credit score by giving me this credit. And you're like, not sure about that. I think one of the things we need to be very careful of there, though, is that perception, the perception that somehow we as lenders affect your credit score. We don't affect your credit score. We don't produce this credit score. That's all done by the Bureau, right? Our responsibility is to report accurately what we're doing, how our lending is working, how your, as consumers, balances are, et cetera, et cetera. But increasingly, I'm seeing kind of consumer groups and even the FCA saying things like, you must be careful not to negatively affect people's credit scores. And I would really like to know what a negative effect on a credit score is. Because if it reflects your creditworthiness accurately, if it's based on real data, is it negative to have a lower score? I'm not sure it is. It actually protects you from further lending that you can't afford. It protects you from, taking on a mortgage that's going to crash and burn in 3 years' time when the offer rate goes to the standard rate. I would like us all, if possible, to challenge the perception of a negative shift in credit score. If it's accurate, it's positive. There we go. That's a fight we may all have to have, I think.
Yeah, Sam?
Yeah, I think just following up on that, I think the weaponisation of FOS fees is a really interesting point, and I think that is, as customer education, in inverted commas, around this grows, I think the situation, compounds, and I think, you have our, I guess, responsibility as an industry to sort of educate our customers, and then you have an individual firm's responsibility and perhaps a mitigation of risk to educate your customers. Now, I think as an industry, we can lobby the regulator to change, but as a firm, I think we have to adapt and adjust in the meantime. We can lobby the regulator, and that may take years to come. And in the meantime, you're going to take the financial burden of that. So I think particularly with regards to the weaponisation of FOS fees, a greater customer education from your own individual firms as well as from a wider industry would certainly help with that.
I mean, Jason, you're smiling. I think just because of weaponisation.
Weaponisation of the case fee.
Yeah. I think you're claiming that.
My claim to fame is that several years ago I was in particularly because I do smaller lending, smaller sums, it's really obvious that if the potential compensation is £150 and the case fee is £650 or what it was £750 at one point, then you get into weaponisation of the case fee. And that's what and the first time I said that was several years ago. When the Chief Ombudsman then said it in one of their reports, I thought, my work here is done. I can retire, that's it, I've done it. But I think absolutely we need to think about that. I think there's good news there, though, in terms of FOS, in that we have CMCs finally being charged to access the system. The old system was absolutely about quantity over quality. Put 1,000 complaints in, doesn't matter the quality of it, because even if 1 or 2 comes back, you're getting your money back. I think they need to have some skin in the game, and they will have skin in the game at a rate that doesn't put off good quality complaints. So there's that. There is a wider review of mass redress that's going on, which I think is great. And the Economic Secretary has also talked about FOS doing is FOS asking the question, is FOS a quasi-regulator? I think everybody here would say yes, that's in financial services. But there's some good stuff going on, and I think there's a worry there that are we looking for deregulation? Are we looking for less regulation? I want to be clear that is absolutely not what I'm asking for. Now, I may be different to UK Finance and the FLA. I like regulation. I want more regulation because I want certainty. I want to know what the expectations of the FCA are. I like that. And my members like that because they tend to not have huge risk teams. They're not banks with 25 people all looking at one sentence and trying to work out what that means and interpreting it. They come to me and they say, what does this mean? What do I need to do? What do I need to do this week, next year? And I'd like to be able to tell them that. So I'm not for deregulation. I'm not for less regulation. I would like to know more about what the expectations are from the regulator because I want to be able to feed that back to our members so that none of us go off track.
And I think that's where part of the concern is about the fuzziness of some of this stuff. Like to Sam's point, where we have an obligation to kind of nurture and educate our customers and help them along. Sure, we do. But then how do we do that without giving advice? We don't have a license to give financial advice, and nor should we. And then I'm seeing bad advice elsewhere. So, another story, because I'm a storyteller. Lady at work, Libby, she's got 1,000 out of 1,000 on her credit score, right? Because we're all messing with our credit scores all the time. But she looks at the advice that she's been given in terms of what she should do to improve her credit score, which incidentally cannot be improved from 1,000. And it says, you should up your utilisation of your credit. And she's like, oh, okay, then if I were to up the utilisation of my credit, would my credit score go up? No, it wouldn't. Like, by definition, it can't. So that's bad advice for a start. But let's say she did have a lower credit score and she were to utilise her credit some more. How far? How far until it becomes a bad idea? And they don't know because they're only going on the basis of your credit score, not on your affordability. So people are being given tosh advice with the best intentions in the world. The consumer is given all sorts of bad, conflicting, not personalised advice, and they're acting on it. And then we somehow are responsible for educating them and nurturing them to the extent that it's our fault if it goes wrong. Interesting.
I think financial education is going to become a big thing within financial services and within the collection sector. And I think I take a slightly different take on that. I think I see it quite positively in terms of, I think it's a customer base that is uneducated in financial services. My partner the other day asked me something about her credit score. I couldn't answer it, and she chastised me. Worked in collections and in lending for 20 years. I said, I don't understand it. So, well, absolutely, and I admit to this audience, but I think there's also an opportunity financially for us as an industry to package that to customers. You know, you look at Netflix, etc. There's subscription services out there now. I think we should not see it perhaps as a constraint, but as an opportunity to educate our customers, and an opportunity for the industry financially too.
Yeah, I'm not against it. Don't get me wrong. I'm just being the devil's advocate because I love that.
There's a question down here. We've got questions on Slido coming through just down here. So are we reaching peak vulnerability? I don't want to sort of steal the thunder from the future sections a little bit, but I mean, just in terms of that, I mean, do you think, I mean, it sounds like there's still more to do. I mean, what's your kind of view on that? I mean, how much more is there to do? I mean, I know we're focused on outcomes. I mean, where do we currently sit? What more do we have to do?
There's lots more to be done on vulnerability, but the phrase, the label vulnerability, when 50% of the population is vulnerable, then how useful is that as a label? And many of my members are working with customers that have multiple vulnerabilities, and that's what it becomes, a conversation about multiple vulnerabilities. And it becomes a conversation about vulnerable to what, vulnerable how can we help you? If we can't help you, how can we send you to somebody or advise you to talk to somebody who can help you? It's a simple process, but it's complicated by those vulnerabilities. Those vulnerabilities in themselves make it a complicated process.
What do you think the future is? I suppose I'm just looking at evidencing here. So we've got board reporting that's coming out. This is the second time of board reporting that's coming round. And we were talking before about how there's stacks of reports, like large reports being done to basically evidence that you're taking into account customer outcomes. We've also got product sales data that I know we've talked about before, which is very granular data that can then be used to say these are the areas where good outcomes weren't evidenced as well, which is coming through. How do we think about that? Because it feels like we're getting into a much more sort of transparent kind of world in terms of what's going on, and that evidencing of outcomes can be held elsewhere outside the organisation as much as inside the organisation. I mean, what should our approach be to that? Sam, I don't know if you got thoughts around that in terms of some of the granular level detail that's going to be asked for.
Yeah, I probably on one side of this, I'm an analyst at heart, so I love data. I can understand why it's problematic to be able to have to provide so much data and essentially open Pandora's box. But I think the problem is fundamentally lower than that. I think we've talked about vulnerability, and actually as an industry we don't have a common standard of what is vulnerability. You talked about vulnerability and what customers are vulnerable to. Customers are vulnerable and have financial concerns as a result of their vulnerabilities. Some do, some don't. Some require Braille. That doesn't influence upon their financial worthiness and current financial impact. But I think fundamentally, if we've got no underlying agreed definition as an industry of what vulnerability is, then how can you trust the data that everyone provides to provide a trend on how vulnerable your customers are in your country?
And any thoughts around this, I suppose, extra granular detail that's going to, because this is the new world we're going into for sure.
Yeah, I've always got thoughts. Anyone here from Lithuania? Anyone dealt with the Bank of Lithuania? No? Let me tell you about it. So in Lithuania, you are not allowed to lend to your customers between 10 p.m. and 7 a.m. Anyone have any clue as to why? Go on, audience participation moment. They're all drunk, that's right. The assumption of the Bank of Lithuania is that their entire adult population is drunk between 10 and 7. I love that. And that is one side of vulnerability. You can just go, okay, there are vulnerabilities we can predict, let's act for them. But it's not entirely personalised, is it? And what about night workers? You know, are they supposed to get up in the day just to apply for a credit card? Poor devils. So there is the side of vulnerability that says everyone's vulnerable. And also, everyone is temporarily vulnerable. You know, you're vulnerable when you're drunk. You could be drunk in the daytime. Oh, I plan to be. You know, that sense of vulnerability has to be personalised. It can't be a blanket, oh, this person's vulnerable, therefore we do this, therefore we treat them as if they were a child or as if they couldn't make a decision. It's just that we need actions. We need to be able to say, if someone is vulnerable, do X, rather than, oh, it's a big red flag. What do we do with a big red flag? Nothing. You know, like if someone's deaf, okay, we write to them. That's an action. Is it a vulnerability? Not once we start writing to them. You know, whilst we're still phoning them, yeah, it's a vulnerability because they can't answer the phone. Unless they've got voice type, but you know what I'm saying. That vulnerability thing has to come with activities that fall out from it. You know, is that back up every conversation in writing? Maybe. Is it get them an interpreter? Is it an English language issue? In which case you've got to question whether or not they could sign the terms or conditions in the first place, and whether or not they're being financially coerced. It's a complex area. I just think the way to go about it is to be educated about vulnerability in the first place, and to understand that equality is not the same as equity. You know, you don't have to do the same thing for everybody. You have to do the thing that works for that person.
But I suppose it seems like we're going to go into a world where we're going to be asked lots of questions externally.
Yeah, sorry, I
externally, potentially from the regulator, and it feels like having the good, I suppose, processes internally is kind of what we need to do. So if they are flagged as vulnerable, we can justify it. And back to your point, Sam, around like we're focused on the good outcomes, right?
Yeah, sorry, I missed the data side of that, which is record that you've done the thing for the vulnerable person as well as why.
Yeah.
You know, that's something that doesn't happen a lot because people are so worried about express consent as well.
I think that's just generally a point that I think we've picked up from Consumer Duty. I think there were some people at the start of this that said Consumer Duty is treating customers fairly with a little bit more paperwork. Now, I think that's not the way to approach this. I think this has been a fundamental change to the way in which the FCA has approached a lot of what we do. But that thing about paperwork is not a bad point. We need to be better. We've seen this with the Motor Finance Commission issues. We need to be better at recording what we do, the decisions we've taken, and that goes to things like what have we done to help this person that has this particular vulnerability? Why did we make that decision? We may get that decision wrong, but at least somebody can see what our thinking was and why we did it. And we can learn from that as well if we can go back and look at our own paperwork as well.
So we're almost at time on this session. There's a good question that's coming around. Sorry? There's a good question there around just the review of the Consumer Credit Act there. Jason, I don't know if you just want to comment on that, just in terms of like, you know, I suppose risks or consequences of removing statutory notices, or I suppose the changes on that. I suppose, I don't know if you had a look through it yet.
Yeah, we were involved in a number of conversations with the Treasury, have been for a while, on the Consumer Credit Act. Once again, I'm different. I'm different, that's true. But I'm different from other trade associations in that I'm not as enthusiastic about the reform of the Consumer Credit Act. And there is a reason for that. There is a reason because there are certain things within the Act that we all know about, we all do, and we've got years and years of experience, we've got court cases that back this up. And I like, for example, on information, I like the idea that I know when I need to write to a customer, what that should include, how we should go about doing that. Yes, it could be updated, it could be changed, it could be altered. It's a bit old-fashioned, but I like that process. And I also like that when that letter goes to a money advice, a debt advisor, and they say, oh, this is the first letter I've received, they'll say, no, this is letter number 3. I know that because I see this every day. You have been in denial up until this point. Let me sit down with you and talk through what your next steps are. I like the fact there's consistency across the sector, And in particular, smaller lenders like that, because they don't want to have to go and create new processes and test them and find out whether they work, and they don't have the resource to do that. They would like to rely on things that have worked well and that they know will work well in the future. So a slightly different view. That is not the view of every CCTA member. Some are desperate for change, but generally that's my view.
So Sam, I mean, that's another topic we're going to watch and we'll probably come back to in November, no doubt, in terms of things that are going on. I mean, just I suppose to finish off, I mean, Sam, and then, I don't know, I mean, what are some of the things that you've got on your radar for the next 6 months before we get to November? I mean, what are the top things that we should be thinking about?
So I think as an industry or as my firm?
Both, I think. I think, yeah, maybe as an industry, but I mean, comment from your firm, but...
I think as an industry, if you're asking me personally what I'm most concerned about, I think the macroeconomic outlook. I think, particularly with low consumer confidence, low business sentiment, global economic trade, conflicts, uncertainty, stresses on business through national insurance, all this I fear is going to manifest as increases to unemployment, which is going to place further stresses and pressures on lending, particularly in the non-prime sector. And it's going to face further pressures on impairment provisioning, financial services down the line. So, yeah, I fear for the ongoing economic outlook, particularly with inflation, interest rates, and customer confidence and business sentiment, and how that's going to manifest in the next 6 to 12 months.
Thoughts.
It's a positive outlook to finish on.
Any final comments or?
Yeah, I would say the macroeconomic outlook is the main thing I'm concerned about, and an increased competition perhaps for not necessarily a smaller pool of customers, but for a pool of customers that is growing less and less confident, less and less able to take on the level of consumer credit that they're accustomed to. But I also fear death and airborne Ebola. Because I am a risk specialist. Enjoy.
Just actually want to throw a bit of positive end on that, actually. I've given you a bit of dark doom and gloom, but actually what I am seeing in this, to your point around saturation of the market and, actually a same or perhaps an increasing pool of customers, particularly dropping down from prime into near prime and non-prime, actually is forcing the industry to pivot and innovate. And what I have seen in the market is actually better offers out there for customers accordingly. You need to, as a firm, maintain your same ROAs with perhaps different price points, and those price points aren't necessarily up. So I think actually a lot of lenders are being forced to offer better products and service to customers to remain competitive, and that's got to be a good thing for the customer.
I mean, I'd certainly echo that in terms of some of the conversations I've had. I mean, the dynamism we have in the marketplace with new lenders, new technology, new data, I mean, it feels unprecedented from what I remember sort of like 30 years ago. I mean, sort of like going right up to the top. I mean, it's much more dynamic, maybe a little bit more messy, but that gives a lot of opportunity for folks as well. So yeah, so I think it's that piece is good as well. So Eleanor, Sam, and Jason, thanks very much for that session. I hope that was interesting for folks, and thanks very much for the comments, and really appreciate it. Just give them a quick hand. So thank you.